Jai Jinendra, and hello to everyone from myself and my co-host Paresh Shah to our Oshwal Financial Education series that we've been running over the last few months. This is the 6th of 8 sessions that we've got planned, and this session is around making the most of your personal allowances. I'll just show you the slides that, the sessions that we've run so far, please. Next slide, please. So as I said, this is the 6th session of 8, basically around making the most of your personal allowances. We have 2 more that we're going to be doing in September and in October, as is shown there. So please do join us for those as well. Next slide, please. So we've designed these sessions really to educate members of the Oshwal community in terms of the financial side of things, as it can be quite complicated. We're only here to really show an overview of these topics and give a basic understanding for everyone. And we would like to make sure that you understand this is not financial advice that we're giving. And if it is something that you would like to get advice on, then we would suggest that you seek advice from a qualified professional in this area. Next slide, please. So as we've been going along, we have been receiving a lot of feedback, which we are very grateful for. And thank you for those people who have been providing the feedback. Majority of people have said that they found the sessions interesting and simple to understand and simple to follow. And we're very grateful for your feedback. Please do keep that coming in. Next slide, please. So as I mentioned, our today's presentation is on personal allowances. Personal allowances are ways of reducing the amount of tax you pay. They come in 2 forms: personal allowances, which is basically like a deduction that you get against any sort of taxes that you have to pay, and tax relief, which is basically a reduction in tax based on certain criteria. Next slide, please. We will go through the personal allowances available and how you can maximize them for your benefit, and show you ways in which you can minimize the taxes that you pay. So I'll hand over to Paresh, who is going to talk you through the next slide.
Jai Jinendra, everyone. Hope you're all well. As Vinay said, we were grateful for the feedback we're receiving from all the viewers, and useful feedback, and obviously everybody who's sent us questions have benefited in one way or another. So personal allowances, everybody is allowed a personal allowance of 12,570 in this current tax year. This is before you pay any tax. So anything up to 12,570, you're not going to be paying any income tax on that. The personal allowances are available to everybody, anybody who's employed or self-employed. The other thing to bear in mind with personal allowances is that if your earnings over £100,000, the personal allowance of 12,570 reduces down to 0 between over 100,000 for every pound that you earn, reduces by £1 for every £2 you earn. So by the time you get to 25,000, you're effectively paying, 20,000, 120,000, you're paying effective rate of 60%. So there are some ways of reducing that tax. And one of the ways is by making pension contributions through your employer by what's called salary sacrifice. Salary sacrifice is effectively an agreement between the employer and employee, and that salary is paid in form of pension contributions. So you do not lose your personal allowance, and also thereby you're not paying 60% tax. So effectively, you're saving quite a lot of tax and benefiting by making pension contributions. Next slide, please. Now, the personal allowance is a lot of people, especially people who are retired, may not use up all their personal allowances because they have a state pension and no other income. So if your income is less than 12,570, you can transfer some of your allowance, up to 10% of your allowance, to your spouse or your partner, civil partner. And that means that effectively, £1,260, you will not pay the 20% tax. You can transfer that to your wife or husband, and thereby benefiting by 20%, which is 250 odd pounds a year, which is, it's a good one, good money to have rather than giving it to the HMRC. In addition, if you're doing a claim for this year, you can claim for previous year as well. So effectively, you could save £500 in first year, and then £252 in the following year. However, that's one thing, is that the transferring the personal allowance must be to a basic rate taxpayer, not to a higher rate taxpayer. So that's quite important to remember. But it's a useful thing, and a lot of people that we know have saved money, and it's not well known. So something worth remembering, especially if you've got income under the threshold. So next slide, please. So Vinay?
Yeah, so also when it comes to savings, you have something known as your savings allowance. And for this savings allowance, it's a 0% rate on the first £5,000 of savings income that you have, which is other than dividends, such as something like bank and building society interest. The tax band is only fully available when earned income, such as salary, benefit in kinds, or pensions, exceeds the personal allowance. Sorry, it's not available if it exceeds the personal allowance, and it reduces to the extent that earned income does exceed the personal allowance. So, for example, if you earn £13,000 a year, the 0% starting rate for savings income reduces from 5,000 to 4,570, taking into account your personal allowance of 12,570. Also, there is a 0% tax is not a true exemption, as it uses a part of your basic rate tax band. You also have no tax on the first £2,000 of dividends that you earned. So for people who have dividends from companies and businesses, the first £2,000 is there's no tax to be paid on that, and then it ratchets upwards in terms of whether you're a basic rate taxpayer or a high rate taxpayer, from 7.5% to 32.5%, and also further than that, 38.1% if you're an additional rate taxpayer. Personal allowances of £1,000 are also available on savings for basic rate taxpayers. So the first £1,000 of interest that you receive from your bank or your savings interest, basically you will not pay tax on, and that reduces to £500 if you're a high rate taxpayer, and you don't get any benefit of this type if you're an additional rate taxpayer. Next slide, please. Parish, over to you.
Thanks. Capital gains tax. Now, this is a gain on the sale of an asset that you purchase, such as shares or property, and you've made a gain on that. So everybody has to pay tax on the gain. However, you've got an allowance of £12,300 each year, each financial year. So the capital gains tax on, say you bought some shares and you sold them at a gain, so basic rate taxpayers, 10% tax. For higher rate taxpayers is 20%. Not for business assets, as it rightly says there. On property, the tax is slightly higher. Gains on residential property, which is not your main residence, it will be taxed at 18% for basic rate, and 28% for the higher rate taxpayer. So slight difference there. So if you are selling property, transferring property, something to bear in mind that there is any capital gain, maybe capital gains tax paid on that. Next slide, please. Some useful things that can be done in terms of tax planning with capital gains tax. We've seen sometimes the husband or the wife own the shares and there's gain on that. So what you can do is transfer the part of the asset to the spouse in order to use the exemption for both parties. So say if you've made a gain of £25,000 on sale of shares, one person, you can transfer the shares into joint names, and therefore you can take account of two allowances, therefore reducing your tax to virtually nil. It's a very brief example, but it's something worth looking at. We see that quite often where husband and wife own shares, individual names, but if they shared that, put them in joint names or split them into two names, it would save money, tax. It would save tax. The other aspect of it is that if you made losses in any particular, you bought a property, you sold a property, you bought shares, you may have made losses. That once you register the losses with HMRC, you can carry that loss forward. So in future years, if you make a gain, you can offset those losses. So for instance, this year you bought some shares and made some losses. You could register that with the HMRC that you made a loss of, say, £10,000. In the following year, you've made a gain of £30,000. You can offset the 10,000, so your net gain is only £20,000. So that can be used, and it's quite useful tool. We don't. I'm sure a lot of people do buy and sell shares, and we do make losses at times. So it's worth keeping in mind when you're doing these things. And sometimes it's worth an exercise to use up the allowances and register your losses. So again, as we said earlier, these are kind of little points, but do take advice from an expert on that. Vinay?
Thank you. Next slide, please. So I just wanted to move on to inheritance tax. So inheritance tax is paid basically when husband and wife both pass away, for example, and their assets pass down to their children or the next generation. And you're allowed there's a nil rate band, which is for inheritance tax purposes, of up to 325,000 of your assets are not charged against inheritance tax for the first 325,000. However, anything over 325,000 is taxable at a rate of 40%. So quite a stringent, quite a penal rate of tax if you don't plan for it. You also have something known as the residential nil rate band, which has gone up from 100,000 to 175,000 over the last 4 or 5 tax years. And basically that adds onto your nil rate band to allow someone to pass assets, as long as one of them is your main residence, to your next generation of up to £500,000. And if you're husband and wife, then obviously if you both passed away, then you can double that up to £1 million before any inheritance tax is payable. So it's on your total assets, including your main residence, any other assets you may have, like shares, like property, like cash, like stocks and shares, ISAs, any type of cash ISAs, savings, all those sort of things get added up. And the total value, if it's more than £1 million, then you will pay tax on it, or your next generation will pay tax on it at 40%. So it's well worth, adding things up and making sure that you've done as much as you can to protect your assets if needed, if it's more than £1 million. Next slide, please. So as part of inheritance tax, there are other smaller allowances which you're allowed to use. There is an allowance of £3,000 that you can give away every year. So every person can give £3,000 away to anyone they want. And that if they've not used the allowance up from the previous year, then you can double it up to £6,000 in the first year, and then £3,000 every year thereafter. So a couple, husband and wife, could potentially give away £6,000 without any liability to inheritance tax, which is quite quite useful and a great way to get money out of your estate into the hands of your children, grandchildren, etc., to save on the tax in the long run. There is also a small gifts allowance, which is £250. You can do as many gifts of £250 as you like. There's no limit to it. So that's well worth using as well. So if you wanted to give birthday money, you wanted to give a gift to someone else, that's a way of doing it by saving tax. Also, when someone gets married, each parent is allowed to give £5,000 as a gift. So if you double that up for each parent, husband and wife give, mum and dad rather give money to their son or daughter when they get married, they can potentially give £10,000 as a gift. And if you think about it, it can happen from both sides of the family. So mum and dad of the groom, mum and dad of the parent can, for the bride, can also give 10,000. So in total, it could potentially be 20,000 that can be given to your children without any inheritance tax to be paid on it. Grandparents can also give up to £2,500 as well. So again, double that up. You can give to £5,000 as well. When anybody can give up to £1,000 to any other person. So just bear that in mind as well. Okay. Next slide, please. The other good way of potentially saving some inheritance tax is that you can gift out of your normal income. So what this means is if you have an amount of income and you have excess income over and above what you need for your expenses on a yearly basis, and you can do it on a consistent basis, then you can show that you don't need that money then to live on, then you can give that to whoever you want as well. And again, that would not be liable to inheritance tax. So it's a good way of moving money if you have excess money or excess income rather to someone else or next generation. You can also give to charity. So this is an unlimited amount. So during your lifetime and on death. So what I mean by that is whilst you're living, you can gift as much as you want to charities. And you can also in your will name a charity, and any money that you name to a charity in your will not be liable to inheritance tax. So you have these strange situations where a lot of people do pass away and leave everything to charity, and they effectively don't pay an inheritance tax on it. So it's well worth thinking about if you're looking at making some charitable donations during your lifetime and also when you pass away. Also, a little bit unknown in this, your personal allowance, your net nil rate band for inheritance tax, 325,000, you can actually give that to a trust. So what I mean by that, you can basically give this money to a trust, and once it's been in the trust for 7 years, it can be outside your estate. So it's a great way of getting money outside your estate, assuming that obviously you're going to survive for the 7 years. Once the 7 years are passed, then you regain your nil rate band again, and you can possibly do the same thing again if you wanted to. So again, well worth thinking about and a great way to get money outside of your estate. So do bear these things in mind. And as I say, if you were to pass away whilst you've made the gift and it's within the 7 years, then there's a reducing level of inheritance tax that's payable, not the full amount. So again, it can go a long way in both ways to reduce your inheritance tax liability. So do bear that in mind. Next slide, please. Parish.
Thanks, Vinay. Excuse me. Pensions are, again, a very useful tool of saving money for your future. The the government has made, or the HMRC and government have made it more attractive for people to save money towards a pension. So if you're a basic rate taxpayer, you will get 20% tax relief. So every £1,000 that you put into a pension, £200 will come from the revenue, HMRC. So pension can be started from age 0, effectively. Children can have pensions. The grandparents, parents can pay into the pension for children. Obviously, the limit is for children is 3,600 gross, which nets to 2,880. So you can pay in 2,880 with the 20% from HMRC. The total amount invested would be 3,600, which is 20% money, which for a child as they're growing up, they would have a nice pension pot by the time they come to retirement, and it's small amounts being saved regularly. For basic rate taxpayer, same thing applies, 20% tax relief on every contribution that you make. So again, £1,000 gross contribution, cost to you is £800, £200 will come from HMRC. For higher rate taxpayers, even more advantageous, 40% will come back to them or to invest it into their pension. So well worth considering those options. Additional rate taxpayers, 550. Now remember, one thing is that for those in employment, you can't claim back more than you've paid in tax. So if you've only paid £10,000 in tax, doesn't matter how much pension contribution you make, you'll only be able to get back, offset £10,000 in tax. It's worth remembering that, but a useful tool. Next slide, please. So I think I've covered that, sorry, 3,600 for children. So the cost is 2,880. And then anything above that is 3,600 on net relevant earnings, i.e. so if your salary is £20,000, you could effectively put 100% of your taxable income into that. So the maximum allowance each year is £40,000. Not many people use it. We know that in practice, not many people are able to put pension contributions, but there are a lot of people who can and do maximize their pension contributions. So again, government has limited the amount you can put into a pension over a period of time, because you could put £40,000 each year. However, if your salary or income is over £200,000, the amount of allowance reduces by £1 for every £2 over £200,000. So at £240,000 income, over £240,000 income, your pension contribution is limited to £4,000. And one of the things about tax planning is you can carry forward your unused allowances from previous years. And if, for instance, you've made no pension contributions at all, you could potentially make pension contributions of £160,000, providing certain rules are adhered to. And it's a really useful tool for people who want to build up a pension pot. Some of you self-employed people may have income, may have had a good income in 1 year and think, well, I don't want to pay so much tax. How can I reduce it? This is one way of reducing your tax. The cap on the lifetime allowance, which is the money that you saved up in the pension, is at the moment £1,073,100, and this is frozen, just like the personal allowance has been frozen until 2026. So what basically this means is that anything in your pension pot, if you have more than £1,073,100, it will be taxed at 55%. It's quite painful if you've got a pot of over £1 million, but there aren't many, again, people who have a pot of over £1 million. But if you've been in a job for many years, it is likely that your pot pension pot will be in excess of this figure. And there are ways of planning so that you are minimizing the tax. Again, as Vinay said earlier, speak to an expert in this field who can give you advice which is appropriate and relevant to you. There are lots of little tools that we, not tools, but based on your circumstance, that some of this can be reduced. Vinay, to you.
Thank you. So just one of the main allowances that a lot of people know about is that you can save up to £20,000 into an ISA on an annual basis. So every tax year you have a new allowance. And strangely, we had a lot of feedback from our last session where we covered in ISAs in very deep detail. And a lot of people didn't actually know that children up to 18 have their own allowance for junior ISAs. So it's quite fascinating to get that feedback and appreciate that people learned something from this last session that we had. And as it says there, for adult ISAs, this can be a mixture of cash ISAs, lifetime ISAs, and stocks and shares. So, for example, if you have a £20,000 limit, you could have a maximum of £4,000 in a lifetime ISA. You could have maybe another £5,000 in a cash ISA, and the balance £9,000 you'd be able to put into the stocks and shares ISA. So you can have more than one, as I say, one of each for that year, and then do a new one with another provider or someone else the next year. With junior ISAs, you can only have a mixture of cash ISAs and stocks and shares. The lifetime ISA is not something that junior ISAs will allow because the lifetime ISA is for people over 18. So again, as we mentioned before, these these ISA allowances are really something that people should make use of, because even if you have cash ISAs, the fact that it's in an ISA rather than in a bank account means that the interest that you gain is not taxable. So you just need to be mindful of where you're putting your savings. Yeah, I mean, I appreciate interest rates are very low these days, but obviously if it's taxable as well, then that can make an even more bigger difference in terms of what you get back as interest. So do bear these in mind. And a junior ISA, a parent or a grandparent can contribute to them, or it could be a mixture of the two. So it's a great way to save for grandparents and for parents, as we previously mentioned in our last session that we had. Next slide, Paresh.
Hi. There are some other allowances which are slightly more complex in nature, and also probably would always need professional advice. Venture capital trusts, you are allowed to invest up to £200,000 per annum, which on this you will be entitled to 30% tax relief. So basically what it means is if you invested £10,000 into a VCT, you can get £3,000 tax rebate on each year. Now, this is particularly useful where income cannot be pensionable. For instance, you have rental income, which is you're being taxed at, but with the rental income, you can't make pension contributions. So you can make pension contribution to the venture capital trust. So that's quite useful to have. The conditions are that you invest in that for 5 years. Enterprise investment scheme, again, investing in newly formed companies, very young companies, you can invest up to £1 million a year. Again, you get 30% tax relief on your investment. Excuse me. You can, if you've got income of, you can go back a year as well. Potentially up to £2 million can be invested. Same as VCTs, the EIS gives you 30% tax relief. So on your investment, if you invested £10,000, £3,000 tax rebate would come to you. So again, those are useful ways. The just on venture capital trust, I'll go back. The income that you get from that is tax-free. So you will receive dividends, potential dividends from that are tax-free. And after 5 years, you're entitled to cash those investments in. The dividend income that you get on VCT is not taxable and doesn't form part of your normal dividend income that you get. I think Vinay mentioned earlier that the first £2,000 of dividend is not taxed. So if you've got shares in Vodafone and you're getting £2,000 dividend from there, and then you've got VCT and you've got £2,000 dividend, £2,000 dividend from VCT does not count towards your normal allowances. It's not taxable at all. So it's not added to your total dividends. An EIS, if you invested in enterprise investment schemes, part of it can be used as an inheritance tax planning tool, because the proceeds from there after investment 2 years can be outside of your inheritance tax as well. The minimum term for investment in an EIS is 3 years. Third, final one, more complex allowance, business relief on first £1 million. So if you've got a business that you've built up and it's being sold for £1 million, your tax rate is going to be 10% on that. That's your capital gains tax minus your 12,300 allowance. So again, all of those things are for people who are, I would say, slightly more sophisticated investors and understand the risks involved in the venture capital trust in enterprise investment scheme. Obviously, business, if you have business, you know the risks involved in there already. So I think those are worth bearing in mind and worth looking at if you have income that you want to reduce your income tax. Next slide. So as we said, always, seek advice. There are lots of free resources out there. Money advice service, which you can have a consultation with them. I'm not sure. I think it's about an hour. You can have a consultation, book in a consultation. They'll give you advice on that. The other website is choices.sjp.co.uk, which again just gives you an overview of some basic financial planning matters that I need to think about. It's nothing about products or anything. It's just purely guiding you towards some thoughts about financial planning. So again, have a look at those websites. And again, I'm sure there are others which we haven't got. We don't include those. We're not including any that involve any kind of promotion. So these don't have any promotions. So do look these up. Next slide, please. So in summary, what we say is, look, check your tax bill, talk to your accountant if you have one. And I think as self-employed people, they all have accountants, but unfortunately, they only see the accountant once a year. It's best to see them before your tax year ends, so you can do some planning and reduce the tax. The accountants don't like you telling them afterwards that, look, I'm paying too much tax. How can I save it? Because once the year is ended, they can't go back. So always good to talk to your accountant or your financial advisor before the year ends, so you can do some tax planning and you reduce your tax. And as we said, use all the allowances you can. There are available. We'll go into a couple more that we haven't mentioned unless Vinay's mentioned them. And always seek advice. I think it's always important. It may cost money, but you will probably save that money in getting a better tax relief, lower tax, and some good tax planning opportunities there. Vinay, do you want anything to add?
No, I think you've summarized it quite well. I think the biggest thing is the opportunities for tax planning is if you start that journey early rather than too late in the tax year. It's always best to seek advice from an accountant or a financial advisor or someone who a tax specialist, etc., so that the planning can start early. It's always difficult when everything is left, as Paresh said, to the last minute, and sometimes too late. if it's gone beyond the tax year end or the annual tax year end. And you make use of your allowances. I think that's the biggest thing, which is quite frustrating when sometimes we see people, I'm sure Parash will agree, where there's plenty of opportunities for people to save money, but the planning hasn't been done, and you're wasting money on unnecessary taxes, which is money out of your pocket, and it's sad because it's money you've hard earned, so it's always worth saving as much as you can wherever you can. I think that's as we've always said along all of these is always to seek advice anyway from a reputable or a regulated person to help you with any of these items we've covered. Yeah, that's.
Did you mention about the rent-a-room at all?
No, we didn't actually. So yeah, that's actually a good point. Basically, one of the allowances that we actually haven't talked about is you're allowed to rent a room in your property, and you're allowed to gain a rent of up to £7,500 per annum. And as long as you declare it, then basically there's no tax to be paid on that. It's only on the excess above that. So sometimes if you've got a big property, maybe you're living on your own, and you think that maybe a good way of getting some income is to rent a room to someone, then it can be a really tax efficient way of income generation as well. And one of the other big areas that we haven't covered today is stamp duty. There's been most people are aware there's been a lot of change in the stamp duty around definitely properties and purchasing properties, etc. But I think because the area is quite complex in that sense, we thought it was best to maybe leave that out. Otherwise, we're going to be talking numbers, and it's a dry subject anyway. It's a very difficult subject, and it's better that if you have any questions on stamp duty, etc., to seek advice because it can be quite complicated area, especially if you're looking to buy properties which are not your main residence, etc. I think we'll go to questions if Barish, if you want to do that, or shall we?
I haven't got any questions at the moment. I think hopefully we'll get some in a minute. But one thing I wanted to ask or mention is that gift out of normal expenditure. I think just wanted to elaborate on that. I think you said consistent. I think it doesn't have to be. I think in the eyes of the revenue, it's got to be regular. So if somebody, a parent or a grandparent, is paying £1,000 a year or a month or a 6 month, as long as it's regular. And is there a record required? How do we keep record? How would the revenue know?
I suppose it's best to have some sort of, at least you've got a bank statement or something which proves where the money is going to. And if you can show that in justification that this money is being given to your son, granddaughter, grandchild, whatever it is, then that should be adequate, I feel. I don't think there's any other requirements to show or any records you need to keep over and above that.
And just again, just on the same subject, the income is income in sort of form of pension or any other income, employment income. Is that correct? Not investment income. If you've got invested £100,000 in an ISA, and you are taking income from that, is that part of?
Correct. Yeah. So basically, that's a great way of actually creating income as well. Is that by taking income from your ISAs, basically any money you take out of the ISA, because it's a tax efficient vehicle, there is no income tax to be paid on that. So it can be a great way of supplementing income in retirement, possibly, or even whilst you're working. It's a great way to get money out of the estate. Sorry, not out of the estate. Sorry, to use as income rather.
Okay. I think I've covered everything that I had in my.
Yeah.
Yeah, on my notes. So I think there's but I think if I haven't got any questions coming up on YouTube, I'm not sure whether there's any glitch on this or not. But yeah, if there's no questions, I think we'll probably wrap up. And I think we'll talk about the next session really.
Next session, yeah.
So the next session we've got is on pension options at retirement. I think it's a really important subject, and I think you'll agree with the number of clients we have who are confused by the options available at retirement. You know, do they buy annuity? Do they do this? Do they do that? And also pension as part of inheritance tax planning, quite important. So I think next session is going to be quite important and something that we people should take notice of, because we want to hopefully try and clarify what the options available to individuals are.
Yeah, I think also one thing to mention on that is pensions have traditionally been quite complicated, and the government a few years ago created this thing called pensions freedoms and flexibilities, which came on the back of that. Sadly, as with anything in life, when they say they're kind of simplifying something, they make it more complicated. So it's really worth coming onto this session to understand what your options are, rather than just the traditional methods of drawing a pension, which are either a company pension or a annuity, are the traditional methods, which in this day and age are right for some people and not right for other people. But it's good to have an understanding of all the options that you do have. And that's something we will cover in the next session.
We've got a question, Vinay. Question is, if the home is worth £800,000 and I leave it to my children, will they pay any inheritance tax?
Yeah, so it basically depends on the total value of your estate. So even though your house may be worth 800,000, on the death of both of the mum and dad, it's down to the total value of your estate.
Yeah, the clarification is that it's my only asset. So if my home is my only asset and I leave it to my children, equally, will they have to pay any inheritance tax?
So as we mentioned before, if you have two allowances between husband and wife, and the total of that is in total £1 million, and therefore if there are no other assets, then I would say there probably wouldn't be any inheritance tax to pay. But again, it would be good to have the full situation and give you full clarification, or speak to someone who can give you that guidance.
So just to reiterate what you said earlier, so the husband and wife both have allowances of 325 each, inheritance tax, a nil rate band as it's called. And yes. Then in addition, the residence nil rate band, which is now standing at 175,000 each. So effectively, jointly, husband and wife will have £1 million worth of allowances. So if we take that example of £800,000, 1 million minus 800,000, so there's no tax to pay on that. If that's a very simplistic way of looking at it, because typically people do have other assets, but if that's the only asset, you're within your allowance, so there wouldn't be any tax payable. But again, as Vinay said, always get clarification, because we're answering that sort of abstract question rather than looking at the whole picture. So.
Yeah, there's another question here as well from Dilip Shah. He's asking, hi, can I ask about gifts? If you gift from your savings, then is it still subject to 7-year rule?
Yes, is a short answer. It's a gift nonetheless. If you're using the allowances, so for instance, if you gift £3,000, then no, the 7-year rule doesn't apply if you haven't used up the allowance. However, once you've used up the allowance, so if say you've gifted £10,000, 3,000 you can offset, so £7,000 is a gift which the 7-year rule would apply.
Yeah.
Hopefully, Dilip, that answers your question, Prithiben, as well.
So yeah, I think in wrapping up, really, I think it's a case of I appreciate there's a lot of allowances that are out there, and some of them can be quite complex to understand. And we try to simplify it as much as possible without giving too much detail. And I would say it's always a good idea, as we keep saying, to seek advice to make sure that your understanding is correct and that you're taking full advantage of all the allowances that are out there.
Yeah. Okay. Thank you all for joining us today, and we will close today, and we'll see you on 16th of September. Thank you. Bye-bye.
Thank you. Bye-bye.